Hey everyone, welcome back to the channel, where we talk all things gold, silver, and the realities of the markets that most people overlook. If you're new here, my goal is to break down what's really happening behind the price moves. No hype, no panic, just facts and perspective. If you enjoy staying informed about precious metals, make sure to subscribe and turn on notifications so you never miss an update. Now, let's get into today's topic. The rally in gold and silver has slowed down quite a bit lately, and many of you may have noticed it. The big question now is whether this slowdown is just a short-term dip or if something more serious is developing beneath the surface. That's the puzzle we face time and again when it comes to metals. Are we just catching our breath, or are we seeing the start of a real shift? My position on this is well known by now, but I want to focus today on what the broader signals are telling us, because sometimes the market speaks louder than any single analyst's opinion. Over the last 2 weeks, gold and silver have both gone through two key phases: a sharp drop followed by stabilization. To be clear, they didn't crash. What we saw was more of a strong correction, a pullback that wiped out some of the excess built up from months of gains. But still, it was the biggest 2-week decline we've seen since June 2013. Gold lost around 11% of its value, and silver fell nearly 15%. When we talk about corrections, we usually mean about 10%, and if it hits 20%, that's a full-blown downturn. So this sits right in between. A sharp correction, but not a collapse. For most physical gold and silver holders like us, the impact is more psychological than financial. After all, none of us bought at the absolute peak of $4,350 for gold just to sell it off immediately. In fact, that price was only available for about a week in early October, so unless you're actively trading, your portfolio hasn't really taken a major hit. What matters more is how it feels to see such a pullback, because market psychology drives the next move more than numbers do. Before we move further, I want to give a quick shout out to Summit Metals, our channel sponsor. They're your one-stop destination for everything related to precious metals. Whether you're looking to buy or sell, they handle both sides with expertise and care. If you're serious about stacking or diversifying your holdings, Summit Metals is definitely worth checking out. Now, coming back to the psychological impact, that's where things get interesting. When rallies slow down, capital starts flowing out. Traders lock in profits, and short-term investors move on. This kind of behavior creates uncertainty and hesitation among long-term stackers. People begin to question whether this run is sustainable. Will gold climb back above 4,355? Will silver regain its position above 54.5? Those questions are starting to echo louder in the market right now. But before we look ahead to where things might be going next, it's important to lay down a few key figures. Gold has risen over 50% so far this year, and in just 4 months leading to its all-time high, it jumped more than 30%. ETF inflows have reached their highest levels in 14 years. Even at $4,000 an ounce, this is shaping up to be the strongest year for gold since 1979. Silver, meanwhile, has shown a similar pattern, surging from $29 at the start of the year to a record $54.49, an incredible 88% increase before dropping 15%. Anyone expecting an 88% climb to continue without any pullback is ignoring market reality. Yet even after the dip, silver is still hovering around $49, which means it's gained roughly 67% this year alone. So while this correction feels dramatic, it's important to remember that both metals are still performing exceptionally well in the bigger picture. So where does that leave us now? Are we witnessing the beginning of a decline? Or is this simply the pause before another leg up? Personally, I don't see this as the end of the rally. I've long expected that gold might cool off to around $3,150 before the year ends. And honestly, even if that happens, we'd still be sitting on huge gains. The market has always moved in waves, not straight lines. So if this current slowdown is making you nervous, remember, sometimes the healthiest rallies are the ones that take a breather before pushing even higher. When we look back at the patterns from the past, it's clear that this kind of correction isn't unusual for gold or silver. In fact, last year in 2024, we saw something quite similar. Around October, gold dropped roughly 7%, sliding from about 2,587 down to nearly 2,560, a sharp sell-off that shook short-term investors and made many question whether the bull run was over. But as we know now, that decline didn't last long. Within weeks, gold bounced back and went on to hit new highs. So, if today's pullback feels extreme, just remember that it's not the first time we've seen a drop like this, and history shows what often follows next: a strong rebound. And that's really the main idea here. Markets breathe. They inhale, they exhale, and that rhythm keeps them healthy. We saw the same pattern play out last October, and what followed was a significant rise in both gold and silver prices over the following months. So when I say this current dip doesn't look like the end of the rally, it's because these cycles have a habit of repeating themselves. What we're seeing right now could just be the setup for the next wave upward. That brings us to what these movements actually mean for investors and stackers like us. If you're holding physical metals, you're not really losing anything right now. Your investment hasn't changed unless you sell. What matters is your confidence in why you bought gold or silver in the first place. Most long-term holders view metals as insurance, a hedge against uncertainty, inflation, and market instability. Those fundamentals haven't changed one bit. Still, I understand how the psychological part of this plays out. When prices fall suddenly, even a temporary dip can feel like a threat. The news headlines start shouting about a collapse. Traders panic, and YouTube thumbnails flash red arrows and dramatic words like crash or bubble burst. But if you look beyond the noise, the long-term picture remains the same. Global uncertainty is still high, central banks are still buying, and investors are still looking for safety. The foundation under this rally hasn't disappeared. Now, let's talk about the behavior behind these moves. For many traders and short-term investors, momentum is everything. When the rally slows, they lose interest because they're not seeing those daily gains anymore. That's when the so-called FOMO buyers, those driven by the fear of missing out, start to fade away. We've reached that stage now. The rush of people trying to jump on board for quick profits has calmed down, which naturally cools the market. But that doesn't mean it's reversing. It just means the hype is settling, leaving space for more realistic growth. From an analytical standpoint, the support levels are where we can focus now. Based on technical indicators, gold seems to have strong support around 3,030. If the price dips to that range, it's not necessarily a bad sign, more like a natural floor where buyers might step back in. Some analysts argue the floor could be even lower, near 3,140, but that's more of a worst-case scenario than an expectation. Remember, technical charts only tell part of the story. The other part comes from global sentiment, central bank moves, and demand for physical metals, which are still quite strong. Now, when we look at what actually triggered this pullback, one of the big factors was the recent easing of US-China trade tensions. As the talks de-escalated, some of the fear-driven demand for gold softened. Investors who bought in anticipation of conflict started taking profits when things looked calmer. That's when ETF holders also joined in. We saw the largest single-day withdrawal since May. These are short-term movements, and they happen whenever geopolitical stress releases pressure. But here's the key. Despite all of that, the long-term view from major institutions hasn't changed at all. Goldman Sachs still sees gold hitting around $4,900 in 2026. Bank of America and JP Morgan are both targeting $5,000. That tells you something important. Analysts at the biggest financial firms are not treating this as the end of the rally. They see it as a pause, a chance for the market to reset before continuing higher. So in a way, this correction might be exactly what gold and silver needed. No market can keep climbing non-stop without shaking out the short-term speculators. A cool down builds a stronger base for the next leg up. And when you zoom out and look at the big picture, gold still up 50% this year, silver up more than 65%, you can see that the trend is still very much alive. This dip doesn't erase the rally. It just reminds us that markets need to breathe before they sprint again. Another thing worth remembering is that corrections like this tend to separate real investors from emotional traders. The ones who entered gold or silver because of short-term hype usually start selling when they don't see quick profits, while those who understand the purpose of holding metals stay calm and patient. This moment we're in right now is a perfect example of that. It's testing confidence. It's shaking out weak hands so that the next wave upward can be supported by stronger long-term holders. If you take a step back, the picture still looks incredibly strong. Even after the correction, gold has gained roughly 50% this year and silver about 67%. Those numbers would be considered extraordinary in almost any asset class. Many mining stocks have also shown sharp growth as a result. So while everyone is focused on short-term price drops, the big story remains. Precious metals have outperformed expectations in 2025. But it's important to stay level-headed. Prices don't move in a straight line, and that's completely fine. For those who follow the market closely, it's easy to get caught up in the noise. All the charts, the predictions, the daily moves. But as an analyst, I try to separate what really matters from what doesn't. The truth is, most of what we're seeing right now is speculation. The long-term insurance value of gold doesn't change because of a few weeks of red candles. Its purpose, protecting wealth and providing stability, remains exactly the same. What we are seeing, however, is a test of patience. Now, when people tell me that I'm too conservative in my forecasts, I actually take that as a compliment. Because when you deal with something like gold or silver, stability is strength. It's not like Bitcoin or GameStop, where the price can double overnight. Precious metals work differently. Their history stretches back thousands of years, and they've always found their value again after each dip. That's why I don't expect gold or silver to just skyrocket in a straight line. Every rally, no matter how strong, needs these pauses. It's also human nature to lock in profits when you've made big gains. If an investment that usually grows around 6% a year suddenly gives you a 60% return, many people will want to take some money off the table. And that's completely logical. That's part of what we're seeing now. Some investors simply taking profits after a huge run-up. But the underlying fundamentals haven't weakened. Demand remains high, central banks are still accumulating, and global financial uncertainty is still supporting metals. If we look deeper into what really drives price behavior, one key factor is momentum. Earlier this year, we saw strong FOMO, the fear of missing out, push a lot of new buyers into the market. Now that the price has cooled, that momentum has slowed. The energy that drove gold and silver higher is resting, but it's not gone. When markets calm down like this, it's often a healthy stage before another push. It allows prices to stabilize, giving long-term investors a better entry point. From a technical point of view, the current setup doesn't show signs of a full reversal yet. Support levels, as mentioned earlier, remain steady around 3,830, with possible temporary dips to $3,440. But even that wouldn't change the bigger trend. The moving averages, volume patterns, and sentiment indicators all suggest that this is a cooling period, not the start of a downtrend. What we are likely witnessing is consolidation, a phase where the market digests previous gains before resuming upward. Meanwhile, if you consider what's happening globally, there are several positive signs for precious metals. Inflation remains a concern in several economies. Global debt is at record highs, and political tensions are still simmering under the surface, even if trade talks between the US and China have temporarily calmed. Each of these factors supports the long-term bullish case for gold and silver. Whenever uncertainty grows, people turn to tangible assets, and that's unlikely to change anytime soon. So, instead of viewing this as a warning sign, I'd call it a moment of opportunity. Markets like this reward those who stay patient, not those who panic. Every pullback gives disciplined investors a chance to reassess, add to their positions, or simply sit tight while the short-term traders exit. The bigger wave is still building, and when momentum returns, it often happens faster than anyone expects. That's why, as a silver analyst, I see this phase not as the end of the rally, but as a necessary pause that sets the stage for the next climb. When we look at the rally from a deeper perspective, it's clear that nothing we've seen so far suggests that the move in gold and silver is over. In fact, these cooling periods often give us some of the most important signals about what's coming next. As I mentioned earlier, I believe we can still go much higher from here, but we'll likely get hints before that happens. Indicators that tell us when we're approaching the top, or when momentum is starting to fade. So, let's talk about what to watch for as this market evolves. The first thing to keep an eye on is ETF flows. When the inflows slow down or turn into outflows, even while prices are still rising, it's often an early sign that big investors are starting to lose interest. That means the easy money has already been made. Right now, ETFs are still showing healthy inflows, which supports the idea that this rally isn't done yet. But if that changes, that would be one of the first red flags. The second factor is central bank activity. Over the last few years, central banks have been net buyers of gold, locking up more than 1/3 of annual global supply. That's been one of the strongest supports for the gold price. But if we ever start to see that flip, if central banks begin selling instead of buying, that could be a major shift. So far, there's no sign of that happening. In fact, most banks continue to accumulate. That's another reason I believe this rally still has more room to run. Third, we have retail demand, which is much harder to measure, but still matters a lot. I've seen mixed reports, some dealers saying they're still seeing strong buying, while others say interest has cooled. From my own conversations, most long-term stackers are cautious, but not gone. This tells me that while enthusiasm has cooled slightly, the underlying belief in gold and silver remains intact. But keep in mind that psychology plays a big role here. When prices go high, people become hesitant to buy, and when prices fall, fear sets in. It's a cycle that repeats again and again. Another important area is futures positioning. Commercial traders, the big players, usually increase their short positions near the top of a rally, while managed money, funds and speculators tend to go long. When those two lines cross, it can signal that we're near a turning point. Right now, we're seeing commercial shorts start to build, which doesn't necessarily mean the rally is over, but does tell us that we're entering a cautious zone. It's worth keeping an eye on because it's often one of the clearest technical signals. Then there's the PA media narrative, which might sound funny but is surprisingly reliable. When every headline and YouTube video says you must own gold, and when even your relatives who never talk about investing start calling to ask how to buy some, that's often the sign that the excitement has peaked. This kind of widespread confidence usually appears right before a pullback, because once everyone believes it can only go up, there's no one left to buy. We're not there yet, but when that kind of overconfidence appears, it's a clue to start being careful. Finally, listen closely to the Federal Reserve's language. Whenever the Fed begins using words like confidence, stability, or excess speculation, it's usually because they're starting to worry that markets are getting overheated. And since the Fed reacts to lagging data, that warning often comes late, meaning the rally has already been going strong for a while. So when Jerome Powell starts mentioning things like overconfidence in asset markets, that's another hint that the rally might be near a temporary top. These 6 indicators together give us a kind of roadmap for understanding where we are in the cycle. None of them on their own can predict the exact turning point, but taken together, they can help us read the mood of the market. And right now, that mood is still more bullish than bearish. We haven't yet reached the euphoria stage where everyone's convinced prices will only go up, and that's a good thing. It means there's still fuel left in this rally. So, while we stay alert for these signals, we also stay grounded. Corrections are part of the process. The key is not to let short-term noise distract us from the long-term picture. Gold and silver still have strong fundamental backing from central banks, from investors, and from global uncertainty. And as long as that's true, the path forward remains positive, even if it's a bit bumpy along the way. Even though the market has slowed a bit, the bigger picture still looks strong for both gold and silver. This short-term pullback may just be a breather before the next big move. Remember, no market goes up in a straight line. Even the strongest rallies need time to reset before moving higher again. What we're seeing now could simply be that natural pause before another push forward. If this recent correction made you nervous, that's okay. It's completely normal. Volatility can test our patience, but it can also help remind us why we invest in precious metals in the first place. Gold and silver are not meant to deliver overnight gains. They're long-term stores of value that protect wealth against inflation, uncertainty, and weakening currencies. So rather than fearing these short-term dips, think of them as opportunities to strengthen your position or to reassess your goals as a stacker or investor. The important thing to remember is that none of this means the rally is over. The underlying drivers, central bank demand, economic instability, and global uncertainty, are still in place. We've seen this pattern before: a strong surge, a pullback, then another leg higher. The cycle repeats, but the direction over time tends to move upward. And even if we do get another small drop from here, that doesn't erase the massive gains we've already seen this year. Gold is still up roughly 50% year to date, and silver is up around 67%. Those are huge numbers, especially for metals that typically move at a much slower pace. That kind of performance tells us there's still significant strength in the market. So yes, while a correction is normal and even healthy, the long-term momentum remains on our side. In my opinion, this phase is simply a reminder, a reality check, if you will, that precious metals aren't magical or immune to fluctuations, but nothing in the current data or sentiment points to a collapse. If anything, this gives long-term holders a chance to breathe, evaluate, and maybe even add to their stacks while others panic. As analysts, we focus on trends, signals, and probabilities. And all of those still favor gold and silver over the long run. So stay patient, stay informed, and don't let short-term emotions override long-term logic. The rally may cool down, but that doesn't mean it's finished. It just means the market is catching its breath. Whether you're stacking for security, diversification, or profit, this is still a market worth paying close attention to. And now, I'd love to hear from you. Do you think this is the dip before the next big move? Or do you believe the rally has already peaked? Share your thoughts in the comments below. I always enjoy hearing your perspectives and insights. If you found this video helpful, don't forget to hit that like button. It really helps the channel grow and reach more viewers. And if you haven't already, make sure to subscribe to Gold Rush Reporter and turn on notifications so you never miss the latest updates on gold, silver, and the broader precious metals market. Thank you so much for spending your time with me today. I truly appreciate each and every one of you who tunes in to learn, discuss, and think critically about what's happening in the world of precious metals. Until next time, this is your silver analyst from Orochi. Gold Rush Reporter. Signing off. Stay sharp, stay informed, and keep stacking smart.